So we're going to discuss about expenditure cycle controls. So to start off, we will start in transaction authorization. So the importance of transaction authorization is to maintain an effective inventory control. In transaction authorization, the agent should authorize every transaction. Transaction authorization also promotes efficient inventory management and it ensures legitimacy of purchase transactions. Transaction authorizations the importance. So the real importance of transaction authorization is that, as I mentioned, it's the inventory control or the effective management of inventory. So imagine if there is no transaction authorization in the expenditure cycle controls, there could be an excessive or shortage of levels of inventory, as unauthorized transactions can result in this because the agents will be purchasing inventories at their own discretion. And as we all know, excessive inventory ties up the cash of the organization. So we proceed with cash disbursement system. Cash disbursement system utilizes the document of the cash disbursement voucher as discussed by the previous reporters. It also provides effective control over the flow of cash. Each disbursement function should not write checks without explicit authorization, and each voucher that is issued in this function should contain the following voucher number and the voucher number which authorizes the disbursement of cash. The reason why the disbursement voucher has voucher number is for the auditor to have an audit trail for every transaction. Cash disbursement system also provides effective control over the flow of cash. Each disbursement function should not write checks without explicit authorization. So since this cash disbursement system is under the transaction authorization, as I've said a while ago, the focus of this is to ensure the legitimacy of every transaction. So in the cash disbursement voucher, there will be no disbursement going on unless the transaction is authorized or explicitly authorized. So now here are the objectives of the transaction authorization or the expenditure cycle controls. First is what levels of inventory should be stocked. We order inventory based on EOQ or what we call economic order quantity. Second is what particular inventory should be reordered. As I said, we base this on EOQ or economic order quantity. And what quantities of inventory should be reordered. All purchase must be authorized, as I said, in the transaction authorization. And as of cash disbursement system, all suppliers' invoices are verified on a timely basis and conform to goods received. So of course, if you disburse cash in payment for the goods that you purchase, you have to make sure that the goods you receive is what you really ordered or is really the level or the quantity that you paid for. And all cash disbursements are recorded completely and accurately. So we proceed with segregation of duties as are done with the transaction authorization. So why do we need to segregate duties? First, we start off with segregation of inventory control from the warehouse. We need to segregate the inventory control from the warehouse because if investors or outside users or internal or external users of financial information, for example, needs information, then the organization would not have a hard time to provide them the information they need. For example, in the level of inventory, the agent must have accurate records of all the levels of inventory that is on hand and that has been spent. So in this way, the organization wouldn't have a hard time to provide financial information to the users. Because if you don't maintain complete records of your inventory levels, then in case someone needs the information about their inventory, you are going to count the inventory level physically and actually at that particular time. So in the segregation of inventory control from the warehouse, the importance of this is that the organization should have a complete record of the inventory levels, and at the same time, someone on the organization should also have should also conduct physical count of inventories in the warehouse, and then the agent's responsibility and obligation is to reconcile the physical count of the inventory in the warehouse and the inventory records. Next, we proceed with segregation of general ledger and accounts payable from cash disbursement. Why do we need to segregate general ledger of accounts payable from cash disbursement? So first, the reason is to prevent the perpetration of fraud or fraudulent acts. Since if an individual has combined responsibilities of recording accounts payable and at the same time disbursing cash, then there might be a tendency that this individual might commit a fraudulent act, because this individual can withdraw cash and then adjust the cash account accordingly. So now we proceed with supervision.
Included in the expenditure cycle control are supervision and accounting records. Under supervision, inspection is highly emphasized because without the inspection, there is a high possibility of theft of assets. That usually happens when the receiving department is at busy periods or in a hectic schedule. Next is the accounting records. Accounting records for purchases process system and cash disbursement system are similar in a way but different in some. For example, the accounting records involved in the purchases process system are the following: purchase order, purchases report, receiving report file, purchase requisition, and the AP subsidiary ledger. We all know that the process in acquiring materials are starting from the request of the department to receive the materials by submitting purchase requisition file to the purchasing department. From there, the purchasing department will submit a purchase order to the supplier, and the supplier, on the other hand, will deliver the goods ordered, and the receiving department will receive it, and they will create a receiving report file to be submitted to the AP department and the purchasing department to let them know that the goods were already received. When the goods were already received, they see to it that all of it were of good condition and of good quality and of the right quantity. Next is for the cash disbursement system. The accounting records included in this are the following: voucher payable file, AP, subsidiary, general ledger, and cash disbursements journal. These accounting records help the management so much when it comes to tracking the cash disbursement or how much cash were allocated in acquisition of materials.
So next is the access control. Access control limits the access to the physical assets. There are two types of access control: direct access and indirect access. Direct access, as the name implies, directly controls the access through using locks, alarms, and etc. It controls the access to those documents containing inventories and cash, and it is directly applied to physical assets, as I have said before. The second one is indirect access. It limits the number of individuals accessing the document. So not all individuals can access one document. There are only certain documents that are assigned to them. So the sixth one is the independent verification. There are two types of verification. The first one is done by the accounts payable department. So it is simply reconciling the documents about the purchase transactions before the firm recognizes the obligations. So there are three types. The purchase order is reconciled with the purchase requisition. The second one, the receiving report, which is the proof that you have received the actual goods, is reconciled with the purchase order. The next one is the supplier's invoice. It is the basis for recording the accounts payable and is again reconciled with the purchase order. The second verification is done by the General Ledger Department. It is simply accounts payable must be equal to purchases, and the reductions in accounts payable, which is the payments, is equal to cash outflows.
So now we move on to risk within the expenditure cycle control. First risk is that orders placed for unneeded goods or more goods than needed. The second risk is that receipt of uncoded goods. No receipt of ordered goods. There are also fraudulent placement of orders by buyers with suppliers to whom they have personal or financial attachments. The fifth risk is that creation of fictitious invoices and other purchasing documents. Sixth is lack of vigilance in writing down inventory that is aged or damaged. Seventh is omission of liabilities such as material contingencies. The eighth one is the overcharges by suppliers for their goods delivered. Number 9 is damage to goods en route to the acquiring firm. And the last one is the errors by suppliers in computing amounts or invoices. Will be continued by.
For the 11th risk is that erroneous or omitted postings of purchases or purchase returns to suppliers' accounts payable records. 12. Errors in charging transaction amounts to purchase and expense accounts. 13. Lost purchase discount due to late payments. 14. Duplicate payments of invoices from suppliers. 15. Incorrect disbursements of cash either to improper or fictitious parties or for greater amounts than approved. 16. Improper disbursement of cash for goods or services not received. 17. Theft of scrap proceeds. 18. Disbursement of checks payable to employees for unauthorized expenses or fraudulent claims.
So number 19 is fraudulent alteration and cashing of checks by employees. Next is kiting of checks by employees. So kiting is the using of bad checks to get creditor money. Then number 21 is accessing of supplier records by unauthorized persons. Number 22 is involvement of cash, merchandise, inventory, and accounts payable record in natural or human-made disasters. Number 23 is interception of data transmitted via the web. Number 24, unauthorized purchase, requisitions, and purchase orders initiated via the web. Number 25, unauthorized viewing and alteration of a company's purchase records via the web. And number 26, breakdown of the web server due to unexpected events.
Today I'm going to talk about re-engineering using EDI or electronic data interchange. Electronic data interchange is the peer-to-peer exchange of business documents in standard electronic format between business partners. So, re-engineering using electronic data interchange. The key element of successful EDI or electronic data interchange is the implementation of a trading partner agreement to eliminate discrepancies that require human involvement. In particular, is receiving functions and the account payable passenger and selling purchase order, receiving reported supplier income or labor intensive and costly. The key features of the system are the following. Okay, that's all. EDI control issues. EDI poses unique risks for organizations that need to be recognized by court. In the absence of explicit authorization, only valid transactions are processed. A trading partner or someone masquerading as a trading partner will access the firm's accounting reports in a way that is unauthorized by the trading partner agreement. So it's like agreement between two parties that become trading one goods to another in form of transactions.